So here I was discussing something about equity accounting. It's nothing but if parent has in hello, all of you are you following?
Sir, yes, sir.
Okay, okay. Yeah. So suppose if XYZ company has invested in ABC company and what has happened is like ABC company has made a profit of $10,000 and XYZ has invested 30% in ABC. So XYZ is entitled to get how much? 30% of ABC's profits. Why? Because how much equity they have in ABC? 30% equity. 30% equity is nothing but their stake in ABC. All of you are following or not? Please tell me.
Yes.
That is nothing but equity accounting. Equity accounting, if you want, you can see a small example. Just excuse me. Hello. Hello.
Yes, sir.
Hello. Hello. Yeah. So I will show you a small example whereby you can get a small some idea about this. So here we are. See, there is this question. I'm not going to teach you question right now. No need to worry. The question is, these are, see, this is a group account, parent, subsidiary, associate. So associate has made a profit of how much here? Can you see this? 57. All right. And the investment what parent has, parent in the sense which investor has done in the investee is to the tune of 30%. So now out of 57, how much they should get 30%? That is 17. Correct? So this is equity accounting. Understood all of you? Yes.
Yes, sir.
Yeah. So now this particular table is very clear to you. Let's move forward. See, I have a small question for you. If there is a company ABC, if it invests in XYZ, 50% or more than this, it is the parent of this. If it is 30% investment, this is the associate of this. Or this both are associate companies. But if ABC has done a 10% investment in XYZ, then what is that investment called?
Non-controlling interest.
No, that is just called a general investment. What is that?
General.
It is not a, it's a non-controlling interest. Absolutely right. But in general terms, we say general investment. Okay. So investment which is none of the above, which is not in this category or this category, is generally for is generally nothing but investment done for improvement in the wealth conditions, that is asset held for accretion of wealth. That is, you have just invested in some company stocks. You want that stocks to grow and you want to enjoy the benefits of that. Okay. So as for single, so here no consolidation is required, no equity account is required, just normal single company accounts you will be prepared. Okay.
Sir,
Yes.
sir, here in the first one, ABC, when it invests greater than 50%, it is called parent na, sir.
Didn't I say parent then?
Yes, a parent only. Next, this ABC, when it invests 10% in any other company, what will it be the for the other company, sir?
What will be
Like in the first case, it was called parent. In this
I said
10%
now
case,
general investment. It's a normal
means
investment.
it.
That's it.
Okay, okay, sir.
Now consolidated financial statements. See, at the end of the year, when X and Y, these were separate entities, now they are a single entity. So X plus Y would be group accounts. In this, nothing but, suppose I'm taking a balance sheet example. Okay, let's do a small question. See, this is a parent company, subsidiary company. I'm not explaining you the question. I'm just showing how the consolidation happens. What is the, how much is the value of property, plant and equipment of parent company?
35,000.
How much in case of subsidiary company?
45,000.
When they become a group, then you need to add both of them and show them as a single
35,000.
account. That is parent
80,000.
company consolidated statement of
35,000 plus
financial statement.
45,000.
Yeah, that is 35,000 plus
45,000.
okay, that's it. So everything you should show in that same way only. Like if you have some idea of intercompany adjustments, I'm not explaining all that to you right now. We'll go in the second chapter and we'll do that. For small example, there is like this inventory 16,000 and 12,000. Now you see they club together and it has become
Interest 12.
20,000. Okay. Same
Okay,
thing
sir.
goes with the liability also. Same is the case with the profit and loss statement. Suppose the parent company's revenue is, let's say revenue parent and subsidiary, it is 10,000, it is 5,000. So when you make group company, that is parent plus subsidiary, revenue you show as 15,000. That's it. Okay. Now, so why are you adding all the figures of every item, whatever you are showing in the statement of financial position or statement of profit or loss, to show them as one single entity? Got my point? That is nothing but I want to show both the companies as one single company. That's the reason why I'm clubbing or I'm adding their figures. Now let me explain you some points here who are not allowed to prepare group accounts or who are exempted from preparing group accounts. First point, if ABC is a parent of XYZ and XYZ is a parent of PQR, so can XYZ prepare group accounts? Please tell me.
No, sir.
Why? It's a parent of
It is
PQR.
already a subsidiary to ABC.
Yes, when a company is already a subsidiary to some other company, they cannot prepare group accounts. Only ABC is entitled to prepare group accounts. And yeah, that's it. So the parent is itself, here the parent in my context is XYZ. It is itself a wholly owned subsidiary of whom? ABC. Or it is partially owned subsidiary of another entity, suppose ABC only, and its other owners, including those not otherwise entitled to vote, have been informed about and do not object to the parent not presenting consolidated statement of financial position or consolidated financial statements. That means XYZ, which is already a subsidiary of this parent, is not entitled to do consolidation. Only in this case, ABC has here two subsidiaries, that is XYZ, a direct subsidiary, and a sub-subsidiary in the form of PQR. So who is entitled to do group accounts here? ABC. Point number 2. Any company whose securities are not traded publicly or whose shares are not sold to public cannot prepare group accounts. Point number 3. It is not in the process of issuing securities in public security markets, as I already told you. Point number 4. The ultimate or intermediate parent publishes consolidated financial statements that comply with international financial reporting standards. That means any company which is already a parent and which complies with IFRS, that company's subsidiary cannot prepare consolidated statements, or that parent has only the authority to prepare consolidated statements, or if they don't comply with IFRS standards, they should not prepare. Why? Because in some countries we don't know whether group accounting concept exists or not. Okay, some African or some Arabic countries, I don't know about them, but maybe there can be a chance whereby they don't follow this concept at all. Okay, now, so all of you please read these points. Okay, let's move forward. We did not miss out any page now. Yeah, okay. No, we missed out on page. Fine. Investment in subsidiaries already we discussed. Power over the investee, exposure to or rights to variable returns from its involvement with the investee, ability to use its power over the investee to affect the amount of investors' returns. That means what should be done with that amount, they will decide. This already we have discussed. Acha, now power. Power, we discussed something in power, na? Power is nothing but these are the 4 points which would say that parent really has power over subsidiary. What are those 4 points? Power can be obtained directly from ownership or of the majority of voting rights. What do you mean by voting rights? What do you mean by voting rights?
To make any decision.
They have right to vote.
Every shareholder who holds shares of some company has those many voting rights as many shares he holds, correct? Every share would carry a right. Every share would carry a voting right. So if I have 1,000 shares in a company, I have this much voting rights. So definitely when I have voting rights, I have power. When I have majority of voting rights, definitely I have power. Understood, all of you? See, parent
Yes,
and
sir.
subsidiary, parent is having 60% holding in subsidiary. So parent has majority of voting rights. So parent definitely has power over subsidiary. But there are some other aspects also which can be considered to say whether parent has power over subsidiary or not. First, rights to appoint. See why I am stressing on this chapter that much, because they can give theory question to you. Once we do a chapter properly, it really reduces your burden of reading theory also. Rights to appoint, reassign, or remove any key management personnel, like what? Company secretary, okay, directors, those are all called key management personnel. So if parent has 60 to 70% or 80% holding in subsidiary, apart from voting rights, they have majority voting rights, they have power, because what shows that they have power? They can appoint, reassign, remove any KMP from the company. Who runs the company on daily basis? They can do that. Rights to appoint or remove another entity that directs the relevant activities. For example, there is a company which parent is kind of holding. Okay, so that company has some major customers. Those customers influence this company. So parent can decide whether to stop dealing with these people. Rights to direct the investee to enter into or veto changes to transactions for benefit of investor. That means parent can ask to do any change in subsidiary, whether whatever can be in parent's favor. Other rights such as those specified in management contract. So that we are not covering here, we'll be covering afterwards. Now, this one is done. Investment in associate, we already discussed. We will just go with the significant influence here. Significant influence, what is the evidence that see, suppose ABC has invested in PQR, 30% investment. How come I can say that ABC has significant influence over PQR? These following points would give me an idea. Representation on the board of directors of the investee. That means ABC company's directors can represent as BOD in this company. Participation in the policy making process, we already discussed. Material transactions between investor and investee, that can happen between them. Interchange of management personnel, these guys can transfer some people here, and these guys can take some people from here. Provision of essential technical information, wherever required, these guys can share those information with these guys. Why? Because these guys have 30% holding in this company, so they can do that. Okay, this is done. This is all now almost done. We covered now. Potential voting rights, we already discussed. See, what is the difference between voting rights and potential voting rights? Anyone? Any one of you? What is the difference between voting rights and potential voting rights? I think all of you are sleeping, huh? I don't know. No one is
No,
active.
sir.
No, sir.
Yes,
No, sir.
Meghna, please tell me what is the difference between voting rights and potential voting rights? Meghna,
Sir,
please. See, there is a difference between shareholder and potential shareholder. Shareholder is existing shareholder. Potential is in future someone can become a shareholder. In the same way, existing voting rights are the voting rights which already existing shareholders have. Potential voting rights are nothing but some kind of securities which are of convertible nature. What is that?
convertible nature.
What are the convertible nature securities? Convertible bonds.
CCDs.
Yeah, convertible preferred stock or share warrants.
Preferred shares.
Now you people can research on this. There are some call options also. Okay, share call options. So all these things would convert some security into equity, and then when they get converted, they will definitely have voting rights. So those are nothing but some voting rights which are not existing right now. In future, they will come into picture are potential voting rights. Now, an entity may own share warrants, share call options, or other similar instruments that are convertible into ordinary shares in another entity. If these are exercised or converted, they may give the entity voting power or reduce another party's voting power. Got my point?
Yes, sir.
Over the financial and operating policies of other entity. So the existence and effect of potential voting rights, including potential voting rights held by another entity, should be considered when assessing whether an entity has control over another entity. For example, if a company has some 40% holding in B company, and they have convertible bonds of B company, those convertible bonds in future would become 30% shares, more 30%. Now A has how much holding? 70%. Got it? So that 30%
Yes,
can be
sir.
called as potential voting rights now, and that is
Yes,
increasing A's stake in B company. Yes. Now, exclusion of a subsidiary from consolidation. Very simple. If a subsidiary is sold, do you think there is a need to again consolidate?
No.
That's it. So we would definitely exclude it, and we will show profit or loss in the statement of profit or loss. Okay. So let me read these points. The rules on exclusion of subsidiaries from consolidation are necessarily strict because this is a common method used by entities to manipulate their results. So if a company is trying to show a subsidiary as some subsidiary which is excluded subsidiary, or they don't want to continue business, or they don't want that company to be with them, they cannot immediately sell it without prior intimation. What did I say you? Without prior See, if at all I am in the month of December and I decide to sell my subsidiary, I immediately sell it without any intimation, without disclosure. Is that acceptable? No. The standard
No.
said it's not acceptable. Why? Let us see. The rules, because the rules are very strict. If you want to exclude a subsidiary from your books, remove the subsidiary from your books, not that easy process. Why? If the subsidiary which carries a large amount of debt can be excluded, then gearing of the group as a whole will be improved. What are you like knowing with this point? Suppose there is a company A and here is a company B, and company B has lot of debts. It's very much debt ridden. So this is kind of bringing bad name to this parent. So what parent assumes is, let me sell this off, let me remove this. If I remove this from my books, then all these debts what this company has, I'll prove that this is insolvent and all, I will be saved. That means my goodwill in the market, which I lost because this company going into debts and not repaying, again can be improved. Are you understanding what I'm saying?
అయిపోతాం.
Hello.
హాల్కి రా పెట్టుకో.
What did you understand with this? All of you? What did you understand with this?
A subsidiary company cannot be.
See, there is a parent, there is a subsidiary. Parent wants to exclude this from the books. That means these guys don't want to continue with these guys. They want to sell all the stakes in this. Why are they want to do that? Why they want to do that? Because this company is having lot of debts. So if this company is having lot of debts, ultimately the pressure is on this company, and this company is bringing disrepute to this company because this company's goodwill is affected because of subsidiary. This is in losses, debt ridden, and no one wants to invest in this group. So what A wants to do? A wants to get rid of this company. So
Yes,
that
sir.
Yes, sir.
A's goodwill can be improved. So can they do that so easily? They cannot do it so easily.
No.
So let us see why. IAS 27 did originally allow a subsidiary to be excluded. This standard allows a subsidiary to be excluded from consolidation where control is intended to be temporary. That means they don't want to continue that business for a long time. They are for temporary basis, they want to continue. So this exclusion was then removed by IFRS 5. That means that particular point was there, but now IFRS 5 has made it strict. No, you cannot sell, you cannot like show that it's a temporary business and remove it directly. No, this see, what is the difference between IAS and IFRS? All of you are learning.
International accounting standards,
International accounting standards.
and international financial reporting standards.
I know that abbreviation very well. I want differences. That you
Sir,
So
are
how to
IAS
maintain
tells
books
about the
of accounts?
accounting.
no. See,
IAS tells about the accounting standards, where IFRS tells about the financial reports.
oh my God, that's great. What is the difference but accounting and reporting then?
So
Yeah.
reporting, it gives the whole performance of the entity.
See, of course, in accounting we'll be doing the journals, ledgers and all, and reporting will be putting all those transactions or items into reports and we'll be showing. So till 2003, IAS was prevalent. Okay, accounting standards were prevalent. Then after that, from 2004 onwards, reporting standards came into picture, and these standards are now to be followed. Okay, we can say like necessary modifications have been done to this, and these standards came into picture. So if you want to study this, definitely you should have an idea of this also. That's understood fact. So what happened is, in IFRS 5, they kind of like bought some rules. So subsidiaries held for sale. Now I am coming to the picture. Whatever subsidiaries the parent wants to sell and get rid of because that subsidiary is debt ridden are accounted for in accordance with IFRS 5 non-current assets held for sale and discontinued operations. So first you should keep that subsidiary in this category, then only you can sell it off. Understood? You cannot directly sell it. as you want. No, the rules are strict now. The rules clearly say, if you want to sell that subsidiary, you sell. But first, you show that in this category. What category? Non-current assets held for sale and discontinued operations. So that an idea would be, an idea the shareholders would have that this subsidiary is going to be sold by the parent. When they get an idea, there's a clear transparency. Got my point?
Yeah, that means you need to wait, close the books of account for the finance current year.
Yeah, first we
And
should
next year
show-
only they can sell.
Yes, we should first show the intention that we want to sell it. Why? Because it is giving us losses since long time. Immediately you can't sell like that. Then there is an element of doubt. Why are you selling immediately something? First, disclose it in that section and then sell it. Now, it has been argued in past that subsidiaries should be excluded from consolidation on the grounds of dissimilar activities. So previously, what used to happen, now Tata Group is a conglomerate. What is conglomerate? Tata Group and Sons is a conglomerate. Any one of you? Okay, fine.
No, sir.
Tata Group is not a company which is into only one particular like product.
Business.
They have lots and lots of products in their portfolio. They are into you have Tata Power, you have Tata Motors, Tata Chemicals, Titan Industries, or Tanishq and all. So they are into diversified business. They make many things. Hence they are called conglomerate. So when why I am taking this example is these are all dissimilar activities. Are they same activities? No, no, they are
No,
all
sir.
different activities. Yes. So previously there was a rule: subsidiaries should be excluded from consolidation on the ground. So I will say Tata's one cosmetic product is Lakme. Lakme is Tata's product. All the women and girls, they apply Tata's this Lakme products. It's Tata Group's product. Many people think it is from France or some other place. No. So there is no linkage between the Tata Motors and Lakme, okay? But previously there was a rule: whenever you see a dissimilar activity, those kind of companies should not be consolidated. But that is the activities, and see, this is all right. The group and the subsidiaries are very different. So that is the activities of subsidiary are so different to the activities of other companies within the group that to include its results in the consolidation would be misleading. But IFRS 10, what they did is they reject this argument. Exclusion on those grounds is not justified because better relevant information can be provided about such subsidiaries by consolidating their results and then giving additional information about the different business activities of the subsidiary. Understood? So IFRS 10 is of opinion that you should not exclude subsidiaries which are of dissimilar activities, because if you do that, a better picture about companies' activities and products would not be known. If you consolidate them, it will give us a better picture about what areas and what products this company is making. Okay. The previous version of IAS 27 permitted exclusion where subsidiary operates under severe long-term restrictions, and these significantly impair its ability to transfer funds to the parent. This exclusion has now been removed. Control must actually be lost for exclusion to occur. So what is that? Last point. IAS 27 was of the opinion that they permitted kind of exclusion where subsidiary operates under severe long-term restrictions. What do you mean by severe long-term restrictions? Any one of you? Yes.
More than 5 years.
Sorry.
More than 5 years.
No. What is the meaning of this severe long-term conditions? See, severe long-term conditions, if I have to say,
So maybe like a subsidiary has to stay at least for that long term and needs to follow the parents' restrictions.
Like even there are any
Long term.
restrictions, the subsidiary follows, operates.
There are like lot of rules in that case, like severe long-term conditions in case like they have not given this IFRS 10, you have to see that IFRS 10. Dissimilar activities is all right. Severe long-term conditions. I was knowing this IFRS 10. What is this severe long-term conditions is? Just a second. Just a second, I'm just checking it out. 2 minutes. Okay, there may be some restrictions for this company. They are working under some restrictions, maybe. Okay. Restrictions are not kind of given clearly. I will get back to this. I will just give you afterwards. So I have to check the rules actually. In our book, this kind of things are not given as far as I'm concerned. I'm not come across. So what they are saying is, there was some previous version of this standard. They permitted exclusion where subsidiary is operating under some conditions, some restrictive conditions, and this significantly impaired their ability to transfer funds to parent. Yes, that condition is like stopping them from transferring any kind of funds to parent because they are under restriction. Maybe some charges on them. What is that? Some blacklisting, some restrictions are there from government. All of you are following now? Hello?
Yes, sir.
Yes, sir.
Some restriction means some blacklisting of that company, or it is into some production of some goods which kind of are restricted or something. So this exclusion has now been removed. Okay. And control must actually be lost for exclusion to occur. What is this? If the company is excluded from the books, there is no control now. Finished. What do you mean by different operating dates? Yes.
Interim.
See, all the group companies will prepare accounts to the same reporting date. One or more subsidiaries may, however, prepare accounts to different reporting dates. For example, December, some companies closing books in December, some in March. So they have to make it annualized. What is that? Acha, let's see. Okay, not March. Let's say September, December. Here they have given an example in C. In such cases, subsidiary may prepare additional statements to the reporting date of the rest of the group for consolidation process. If this is not possible, subsidiary accounts may still be used for consolidation provided the gap between reporting dates is 3 months or less. That means you need to annualize. What do you need to do?
Annualize.
Annualize. That means if at all December has passed and some company is preparing the accounts for March. So now if the group, if the parent prepares for December and subsidiary prepares for March, they need to convert it for 12 months. If it is short of 12 months, if it is more than 12 months, whatever the case may be, they should make it for 12 months so that the consolidation can happen. Now, uniform accounting policies should be followed. That means parent and subsidiaries should try their level best to follow uniform accounting policies. For example, if this parent is using straight line method for depreciation, subsidiary should also use straight line method for depreciation, or diminishing balance, they also should use diminishing balance. If LIFO for inventory valuation, here also LIFO for inventory valuation. Let me tell you, LIFO is not followed in IFRS. FIFO and APCO is followed in IFRS. LIFO is banned in
So for
IFRS.
consolidation, sir, for consolidation purpose, the only accounting standards are should be matched, or even the methods of depreciation or other internal methods also be affected in the consolidation?
Standards and policies are different, Mr. Srinivas. Accounting policies here clearly means I'm speaking about some methods like LIFO, FIFO, APCO, and all.
Understood.
Understood? Hello?
So I'm thinking that may subsidiary may adopt
See,
SLM.
standards they have to follow. Standards should be followed by every company, and standards are always same. But standards give you the chance of following either this or this, na?
For example, so for
As
example,
for IFRS, as for IFRS, you can use any method for depreciation, either straight line method or either diminishing balance method. You can use, but do you have some other standard to follow for depreciation for like property, plant and equipment? No, na. Standard is one. Parent and subsidiary follow the same standard, that is International Accounting Standard 16. But methods they can follow anything that they have the discretion. So what they are saying is go for uniform policies so that consolidation would be easy, comparison would be easy. Understood?
for example,
Example of
US
given-
based company, parent
Okay.
company is US based,
Uh,
and Indian company, the subsidiary company.
So what?
For
Group
consolidation of the is a parent company.
okay.
So what method they need to adopt the policies?
Mr. Srinivas,
IFRS or
Mr. Srinivas,
yes, sir.
US company is having a subsidiary in India. So
Yes, sir.
in previous years, what used to happen is all the statements which are prepared in India is as per Indian accounting standards. Whatever the statements are prepared in United States is as per US GAAP. So they used to translate the Indian accounting standard transaction treatment to US GAAP treatment. They used to translate and they used to consolidate. You understood?
Okay, sir.
Because the account US GAAP is different from Ind AS, na? Here inventory here inventory cost flow assumption is different from here inventory cost flow assumption. Here here they use double declining method for depreciation. For example, here we don't use double declining, we use straight line. So we both differ. What they should do is they should bring it to their treatment and then consolidate. But now because of IFRS, all this is not required. These are global standards. India also following IFRS and other countries also are following IFRS. So no need to translate. These are global standards. Like if I know Hindi and some Chinese and Chinese people know Mandarin. So if I have to do something in China, I should learn this language. If Chinese want to do something in India, they should learn this language. Now, because of English, if we both know English, no need to learn both languages, no?